Well, this week's interest rate announcement from the Bank of Canada has many of us thinking about our debt and credit rating, and it turns out that you might not even know what's hurting your credit. Joining us now from Sands and Associates is Blair Manton. Blair, thanks for being with us today.
Thanks for having me.
All right, so I guess first off, we should start off by talking about what your credit rating actually is and how it's calculated.
Yeah, so a credit rating is basically, it's a record of your financial life. So there's two bureaus in Canada, there's Equifax and TransUnion, and they get data from everybody that you borrow from, whether you pay back the obligations on time or not, and they develop that into an overall rating and a score. And that's important because that's going to determine what financial products are you offered, at what price, and whether you'll even get them at all. So it can be important.
All right, and since it's a big picture, there's a lot that can affect it. And you have some great tips for us, the 5 sneaky credit killers, so to speak. So let's start with the first one.
Yeah, the first one is when you wouldn't anticipate unpaid cell phone bills. If you can believe this, the number one reason why people don't get approved for mortgages, which is a massive debt, is often the smallest obligation they have each month. They just don't attend to. So we all know we pay MasterCard and Visa every month. Sometimes our cell phone bill can suffer or go a few days late. Cell phone companies are notorious for getting collection agents, putting negative stories on credit. So make sure you pay that cell phone bill on time every month, or your credit rating will take a hit and you won't know about it.
Yeah, I'm sure there's a lot of people out there that, didn't realize that was having such a big impact. All right.
Definitely.
Also, high balances.
Yeah, very simply, high balances equals a low credit score. So the key thing that credit grantors are going to look at is credit utilization. And that's if you've got a $1,000 limit, are you bumping up at $900, $950 every month, then you're at 90 or 95% utilization, and credit grantors get nervous. So the magic number is 50%. So if you're running a balance on your credit cards, even if you're paying it off each month, try to stay below 50%. And sometimes that means having 2 cards, and they don't have to have high limits, but 2 cards that will allow you to stay below 50%.
That high balance, does that have to do with mortgages? Because, I mean, that's a loan or a debt as well.
Yeah, they tend to care more about your unsecured debt. So again, your credit card balances and things like that. Your mortgage, you're going to draw that down over time.
For sure. Okay, this is another interesting one, and it has to do with old credit card accounts that you might have that you may not have closed.
Yeah.
What's the good thing? What do you want to do here?
Well, this is very counterintuitive. So a lot of times if people are going around and applying for a mortgage, they go and they close down a bunch of their old credit accounts to show the bank, okay, I've only got a couple credit accounts, I'm keeping up on those. But what you do when you close down old accounts is you lose all the history. So if you had paid that credit card, on time for the last 6-7 years, it's showing great. As soon as you close that account, that's all gone off your record. So you might have closed down all of your history there and just have a couple new accounts, and the bank won't be able to give you the rating that you need.
Darn.
Yeah.
Okay, co-signing debt.
Yeah, the way I say this is don't let anybody wreck your credit for you. And when you co-sign a debt, you are responsible for the full amount if the person doesn't pay it back. And if the person starts to get delinquent on their obligations each month, that can report on your credit as well. So you might not even know the person is missing payments and it's going to collections, but your report is getting a ding.
All right. And then applying for more credit.
Yeah, so if you're going around consistently applying for more credit, people are going to be doing credit checks, and when a creditor provides a credit check on yourself, that shows up as a record, and the more of those you have, the lower your rating is going to be, excuse me, because creditors get nervous that perhaps you're going around town applying for a bunch of credit and you won't be able to satisfy it all if everything gets granted to you.
All right, I've also heard if you check your credit, that hurts your credit.
Right, and that's a double-edged sword. So if a creditor checks your credit, it does hurt your credit. That's called a hard hit. But you, as a Canadian, you have the right to check your credit anytime you want, and there's no impact to your rating. You can get your report for free at least once a year from each of the credit bureaus. There's a link on our website to get the form to download, or you can go direct online. But you can get your report for free. It doesn't impact your score.
All right, a good reminder, these 5 credit killers. I guess take action now, and then maybe in a couple of years you can reverse the damage?
Yeah, I think the important thing is that a credit rating is not permanent. Even if you got a terrible rating now, you're missing payments, or even if you've been through a bankruptcy, it can be as quick as 2 or 3 years. You can turn things around and qualify for a mortgage, and if it's not as severe, you can turn it around quicker, sometimes just a few months.
Awesome. Blair, great information. Thanks for being with us.
Thank you.